The Fed held rates steady once again, signaling a cautious approach as economic uncertainty remains, the labor market is solid, and inflation remains somewhat elevated. But as volatility fades, investors are asking, is this the time for fixed income investing? Well, we're going to get into that, plus discuss where risks could be hiding right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thank you so much for joining me today. My guest here with me for this conversation is Leslie Falconio from the Chief Investment Office. Leslie, good to see you. I want to get right into it because it's been a pretty busy week, specifically when it comes to monetary policy. We did have the Fed decision this week, and as I mentioned in the intro, Powell and the Fed decided to keep rates unchanged. I wanted to ask you, though, did you see anything that surprised you when it came from either Chair Jay Powell or even Treasury Secretary Bessent? And let's talk about that market reaction.
Well, let's first off, thanks for having me. On the refunding side with Bessent, actually, there really weren't any big surprises. And, Anthony, you and I have spoken about this before numerous times, particularly when we were going through those pockets of vulnerability because of the bond vigilantes and the concern that all the supply would come to the market as the deficit rose. And I think, Bessent has stated very clearly, and he reinforced this with refunding, that the majority of the deficit will be funded through the short end, meaning T-bills, in order to, for two reasons. One, he has no interest in locking in a 10-year at, 440, right? That's the first thing. Second thing, he has no interest in pushing that back end yield up unnecessarily, particularly given what's happening with the housing market. So what they've actually done is somewhat of the opposite. They're funding right now through T-bills, and they also increased their buyback. So they're buying the offer on 20 years, right? The Treasury Department, they've actually increased that. So while the market was expecting this kind of rhetoric, you never know what a statement would say, but it really gave comfort in the sense that there's a highly unlikely probability that they increase coupon issuance in 2025 and probably not even through the second half of 26. So we had a sigh of relief there. When it came to the Fed, well, the market wasn't expecting the Fed to cut. I mean, there was like a 2% probability going in. He was a bit more on the hawkish side, particularly during the Q&A segment. I think that, he stressed that the dual mandate of full employment and price stability, but, how many times he talked about the labor supply imbalance, meaning that, yes, there might be fewer non-farm payrolls on a monthly basis, but there's also fewer supply given the fact that we have adjustment from immigration, right? So he really emphasized these imbalances, sort of like on one hand, on the other, and mostly pointed to what to look at is the unemployment rate. Now, obviously, we have payroll tomorrow. The consensus is running about 105,000. When you think about what it was doing last year, that might seem very small, but in actuality, it doesn't have to be that large. So I do think that the market took that hawkishly because he continued with the wait and see, but was really more of the we're not sure. There's still a possibility of inflation rising these next couple months. And Anthony, as you and I have spoke about, our expectation is that inflation rises as well, but it's really about the delta, how fast it rises, or if it's going to rise slightly but stay high for longer. So what's happened is the market's saying maybe September is not such a high probability. They moved it down, September probability down to about 40%. They only have 36 cuts in 2025, 33 cuts, but they still have about 75 cuts in 2026. So the totality, the 100 basis points is remaining. The timing is just shifting.
Right. Yeah, it was really interesting to hear, as you said, that kind of almost hawkish tone out of Powell. But on the flip side, and by the way, also we had two Fed governors dissent wanting to cut rates yesterday. So it'll be really interesting to see.
Anthony, that wasn't a surprise as well.
Right.
Everyone knew that they were, even though it's been the first time since the early 90s, that was projected to occur as well.
That's right. Yeah, like so it was definitely telegraphed a little bit as well. So, and interestingly, I want to get back to something you were talking about. There's this sort of sense of complacency in the markets, particularly on the fixed income side. When you look at the volatility index, the VIX, which we all track, and it is at right now 15 or so. The lowest historically for the existence of the VIX is 14.9. So it is literally sitting at all-time lows on the volatility index. And with that comes this sort of sense of complacency in the market and investors. Do you think that investors have become too complacent, given that there is so much uncertainty, that there is still a risk of inflation with tariffs, as Powell put in the statement from the Fed? What do you think we're ignoring that we should not be?
Well, listen, I think that the market, when it comes to this uncertainty part, I think part of that has gone, a lot of it's gone by the wayside. Not meaning that, listen, tariffs, whether the effective tariff turns out to be 15%, it could be higher. But from what the market went through in April, a lot of these unknowns are now known, right? At least for the time being. And same with it comes to the big beautiful bill. So there's a certain amount of uncertainty that I understand is coming down, and that should happen. What's interesting about not just the VIX, but we're also seeing this in the interest rate vol. Interest rate vol is at several year lows. And with the uncertainty about what the Fed is going to do and the still wait and see outlook, normally when that happens, every data point has a tendency to move the market, right? We've seen this before. The market forecasts too many cuts and they take them out, and vice versa. You have this convergence and divergence of what the market's projecting and what the Fed is guiding. So I do think there's a part of it which is understandable, right? Given the fact that we have a little bit more certainty than we saw in April. But there's no question that when we look at where some of these valuations are, and I know we're going to talk about this in a bit. I mean, spreads are tight. And I look at the 10-year, right? The 10-year has been stuck in a range about 4.25 or 4.75 for a very, very long time. And given the fact that volatility, and I'm talking about interest rate vol now, even though we know the VIX is low as well, has come down. Normally, when that occurs, you're setting up for a breakout, right? And whether or not our view, right, is over the long term, you go to 4%, right? But we can't rule out that breakout might be slightly higher over short term if we get a strong employment. If inflation for a month comes out, a tenth more than anticipated, how the market will continue to react to that data dependence, that's when you're going to get a bit of this volatility.
Right.
So there's partly that's explainable. There's part of it that I do think that uh, it may be a little bit too low right now, and we're looking for it to go up in the latter part as we get this data. So we're not out of the woods. You're going to have these pockets of vulnerability without question.
Right, of course, and we'll certainly have to keep our eyes on that. And additionally, it seems like staying overly defensive within your investment strategy, it's lagged a little bit this year, even with this heightened uncertainty, which continues with this complacency kind of feeling. So how are you advising clients right now in this environment? And as you just keep saying, we still have a lot of economic data that's going to happen between now and the next Fed meeting in September, and certainly before the next one at the end of the year in December. What should clients be doing right now, and investors?
It's really interesting because when we think about that April time period, I think one of the drivers, I believe, to this, technical bid that we've seen in the credit market, it's both US and abroad, but I think part of it too in the US has been that during that April volatility, I think you had a lot of institutional managers, underweight their bogey, meaning that if they should have a certain percentage to lower quality credit, they kind of moved back a little bit, given what was all those unknowns then. So we did have a part of this catch up that we're seeing, right? But now when we look at some of these spreads, like as you mentioned, high yield is one of the top performing asset classes, say at a 275, that 25-year tight is at 240. Okay. Triple C's are starting to tighten in now as well. We think it's quite excessive in our opinion. Now, that doesn't mean, right, that you're going to have this big blowout. No one's calling for that because fundamentally they still are strong. We know high yield termed out their debt. They're at a 3-year part of the yield curve, which has benefited this year. They have higher credit quality. Defaults are remaining very stable. So there's nothing that's there that's saying, okay, my God, we're just going to see this huge pothole. They're just simply too tight. And although we look at the corporate market, at a 79, 78 basis points, and the tight is 77, right? They still are very tight. But in the corporate market, at least, there's two components that we have. One being if growth should slow, interest rates should come down. So I have that interest rate component. And two, obviously, the higher credit quality, if in fact growth should slow, which we're expecting it will, that without a recession, that you're still going to have really good carry and have not as much embedded credit risk. And the same goes for things like agency MBS, where you could pick up yield versus a triple B corporate and still, have a lot of income and a lot of spread. So right now we are looking at the higher quality, those sectors that have been higher correlated to the equity market are the lower credit quality, which obviously have done well. And again, we're not looking for a huge pothole here, but there's no question that they're tight.
Right. And let me one last question for you, Leslie. Is CIO research, you and the team, are you still avoiding the back end of the yield curve? Because it looks like the market is actually pricing in a steeper yield curve at this point, where the short end might actually come down in yield. So are you still looking to higher quality sectors given where you expect the yield curve to go?
Yeah, we would listen. We were early on this call, and I'm very happy about that because now it's a consensus call as a steepener. But we actually started the steepener back in the second half of 2024. And we had the steepener coming on after 2 years of inversion. And our view is the curve will continue to steepen. But right now, you're going to have these pockets of flattening, which is what we're seeing right now, right? And the reason why you're having this, this small window flattening in our belief, because we do think the curve continues to steepen, is the market's going, well, maybe they're not going to cut in September, right? Well, maybe they're not going to go, 75 basis points in 25. They're only going to go 30. But you have to remember, now all of that is priced in. So, in our view, and Anthony, you and I have talked about this before, the more the market moves to an extreme, meaning that, okay, no Fed cuts in 25, and I'm only going to say 50 Fed cuts in 26, is when you push against it, right? And we've talked about that level of buying the 2 year, right? That 2 year at around 4%, I think, is really becomes very attractive, okay? Because then you want to push against what the market is pricing in. And we've done that, and it's actually worked quite well, over a pretty long period of time. So we do think the curve steepens. We do think it's led by the short end going lower. We are in the intermediate part of the curve where we have been, that 5 year area, right? Because we don't want to take on too much excessive interest rate risk right now. We're avoiding the back end, yes, but I will say that there has been a bit of, weight off your chest in terms of what the refunding is going to look like that helps the back end. What we don't know is the actual inflation impact from tariffs, what that delta is like, and how long it lasts. So that's why we stay away from the back end. Probably maybe in 3 months that will change, but we're keeping with the intermediate part of the curve.
Excellent. Leslie, thank you very much. Perfectly succinct. Also, thank you for giving us your guidance here, especially on the investing front, because right now there is a lot of uncertainty that remains, and it's nice to know where we should be focusing our attention on the investing side. Leslie Falconio, always great to have you. Thanks for joining me, Leslie.
Thank you.
Yep, and for more information, please visit ubs.com/views. Lots of content there from the CIO research and investment management teams. And you can also follow UBS on social media. We're on LinkedIn, Facebook, and Instagram. You can check out our Instagram channel at UBS Trending. Lots of content there for you to peruse. And as always, if you have any questions about what Leslie and I spoke about today, please continue this conversation with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everyone. And remember to keep your eyes on what's trending. Thanks, everyone.